Start the recording. Share screen. All right, y'all should all be able to see the PowerPoint at this point. Give everybody just a few more minutes. All right, well, it's 12:30, so we'll go ahead and get started. Any questions at this point? Does everybody feel comfortable? Everybody see everything at this point? All right, well, we're going to jump in. So this semester, I am just going to use the slideshows that they provided with. This will just be a highlight of what's in the textbook. Again, the goal is kind of Tuesdays, we'll run through the slides, discuss any high level on the theory side. And then in Thursdays, we'll jump into some more of the practice and get through whatever we didn't get through. With that in mind, I'm not going to go over every single slide. I'm not going to go into the details of everything, but the idea is just to kind of add a little bit more discussion. There we go. So with that in mind, for chapter 1, we are talking about financial accounting and the accounting standards. So the purpose of this chapter is to exactly understand what is financial accounting. So the first part of that is the finance section. So already, when you talk about accounting as a whole, you have managerial and financial. We're on the financial side of it. So that means that we're talking about external views. We do have rules and regulations. Those rules and regulations need to be followed in order to present the financial statements. Those financial statements need to be comparable between entities. And we kind of go through exactly what is financial reporting. Any questions on that up to what is financial accounting? And again, most of this section and most of this semester is going to be, each week there'll be a little bit of a review of what we learned in principles. But in principles, you learn the what's, and now we need to start discussing the whys and how it came to be. Okay. All right, so what is financial reporting and what is it that we do? So the goal is that we identify, measure, and communicate to economic entities, of an economic entity to an interested party. So the key here is identify, measure, and communicate. That is the job of accounting, is we are the translators. So we identify a transaction, we figure out how we can record it into the set language that we're used to, and we communicate that to the external viewers, okay? So when we're talking about financial reporting, there's the economic entity. So we draw a circle around a business, an activity, person, a partnership, whatever the economic entity is. We're looking at what happened in that entity, identifying it, measuring it, and then communicating it. Okay, so what could be in the economic entity, what financial information is available? That's our job, to identify, measure it, and communicate. How we communicate is through the financial statements. Those financial statements are balance sheet, income, cash flow, owner's equity. These 4 you've heard of and should be very familiar with. We're going to add to that the disclosures. To give you a reference point, balance sheet, income statement, statement of cash flow, and statement of ownership is each 1 page. The entire financial statements is usually 200 pages. So you can see that majority of what actually gets reported is in the disclosures. The problem is that the disclosures are not a monetary concept. Most of the time they take what's in the financial statements and we're going to provide more detail, more information, and that's where you get all the extra pages. But at the end of the day, we have to get it to the financial statement in some form, okay? In that, there's a lot of other uses. So president's letter, prospectus, these are just additional commentary. Prospectus is going to be a future forecast of what's occurring. We have different reports. So as you know, everybody has to file your tax return. If you have a governmental contract, there's specific reports that go out to that. In a news release, there's different forecasts, there's environmental. All of these are additional areas where we report outside of the company. So they are considered part of financial reporting, financial accounting, but they are auxiliary. So most of the time, these reports are going to rely on these financial statements. It's just for news releases, we're going to take a specific portion of it and just announce what our earnings are, or just announce how this operating segment did. Forecast, we're going to take the income statement, but we're going to project it out into the future. Okay. All right. So the reason that we go through this process and the reason that we're presenting this information is for the end user, whether that's an investor, a creditor, a government or agency. We want the end user to be able to make a useful decision. And the decision that we're most concerned with is capital allocation. Okay. So capital allocation seems like a big, complicated word. It's not. Capital is money. Allocate is breaking it out. So capital allocation is how do you want to spend your money? Okay. So as an investor, let's say I want to buy a stock. I have $100. The question is, which stocks should I buy? That is a capital allocation decision. I have capital, $100. I need to allocate it to certain stocks. Which stocks I decide is the allocation. Okay. So the goal is for our financial reports to allow for that user to make that decision, whether it's to purchase the stock, whether it's to invest in the company. As an employee, you make a capital allocation decision because you're allocating your time to this company in the hopes of the company paying you not only today, but a future and a retirement goals. But again, so capital doesn't necessarily mean money. There are other resources available, but for the most part, capital allocation is going to determine how do we invest our resources. Okay, so I'll do that. The only difference, so we are going to break out lenders and equity investors. So the main difference is whether or not you get ownership, right? So if they get ownership, that makes them an equity investor. And so that is part of that. There's no legal liability for any future obligation, but they do get the earnings, their share of the earnings of the company itself. Lenders and other creditors, they don't have any ownership. They don't get to make any of the internal decisions. But as you can see, they're going to be very wary of what your financial information is presenting. So with that in mind, so there's general purpose and then special purposes, but the point is that, so you're going to have general purpose financial statements. Those are the balance sheet income. But specific investors or creditors, they depending on how close they are, they might need to see this information in a little bit different manner. Entity perspective, again, this is just the economic entity. Theory is just that you have to be able to view the company separate and distinct from their ownerships. Even in a sole proprietorship, we still want to look at what is the company doing versus what is the owner doing. Okay, so we want to keep that separate and not blend those. When I tell you about doing your own personal balance sheet, that you are the company in itself. So take yourself away from your mom and dad who might own part of your outcome. But that's the point, is that NT perspective is we need to be able to draw a line, a circle around that entity. While we go through this, we need to be, I said, our information is there so that the end users can make a decision. With that in mind, any information that we present needs to have usefulness. Sorry, 1 second. So what decision usefulness means is that we need to gear our information to what the user is using. So the key everybody's looking at is cash. Cash is king. So we need to be able to have the financial statements in a manner so that they can see what that inflow is. At the second time, we need to be able to show what the future prospects of the entity is. So we need to be able to show what capital is available, what are our current and long-term obligations, what is just the general essence of the company at that point. So I said that the goal of financial reporting is to give the information to the end user. The end user is going to be comparing your information to a variety of examples. And so in order to be useful to that investor or to that creditor, when they see your financial statements, they need to be in the same language as every other financial statement. Okay, so I compare this to just the different foreign languages. If everybody spoke a different language like they do, it's going to be hard to understand it without that investor learning how to speak French, learning how to speak German, learning how to speak English, learning how to speak Japanese. So instead of making the investor learn every single company's language, instead, we as the company are going to learn one language and use that, and everybody's going to use that language. Okay, that language we call GAAP, generally accepted accounting principles. You can see in this environment how difficult it is for everybody to agree on something. So even though we use the same language, we have different connotations. So because of that, we have to have some set of guidelines, some set of rules that we can go to and rely on, so that everyone knows that we're playing on the same playbook. Okay, so in the US, those guidelines are determined by the FASB. The FASB is a public entity that is chartered by the SEC. So the SEC relies on the FASB to generate the GAAP. SEC is a governmental entity, so SEC gets its power and authority from Congress. AICPA used to be what we had. They created the initial versions, and since then, we'll learn about the different scandals, but since then, AICPA is more geared towards the professional. So AICPA is in charge of determining the CPA requirements and what the CPE, what requirements are there to be an accountant and all that. So the AICPA focuses on the people. SEC kind of oversees everything, and the FASB deals with the rules and regulations. So do kind of understand the differences between those? Make some flashcards and make sure. So the SEC will start with, they get their authority from the government. Congress passed the 1933 and the 1934 Act. What that says in summary is that if you are a public company, you must submit financial statements every year to the SEC. Those financial statements are subject to oversight. SEC has the ability to fine and even disband an entity's ability to be public. The difference between the 33 and the 34 Act tends to be the whether or not you're the initial offering versus subsequent offering. I'm not going to get into that level of detail. The point is, if you're public, if you want to list yourself on the stock exchange, you have to follow the SEC's guidelines. If you're not for profit, you still need to go towards these, but they're limited. And if you're private, they're more of a guidelines, but not necessarily a hard fast rule. Any question on the SEC? AICPA, like I said, they're more on dealing with the accountants themselves at this point. They were established a while ago, but nowadays, again, their goal is the CPA license. So we do give them credit because they did start GAAP with what used to be the ARB. That's no longer in play. It was replaced by what FASB gave. So FASB used the board, but then created their own. So the FASB does have 3 different foundations within there. I'm not necessarily worried about each of these. The key is that together, the FASB is there to address issues with GAAP as necessary. So you might be surprised to know that not everybody agrees on exactly how a specific transaction should be recorded. We'll get into some of those intricacies. That's not a word, but we'll get into exactly what those differences are and why. But the FASB is there to take those considerations. And again, the end goal is to be useful to the investors. So if the SEC or anybody else is getting feedback that the investors don't have what they need to make those decisions, it's FASB's job to go in there and to figure out how do we address GAAP to address those needs. Okay, and so this gives you the general guidelines of how exactly the principles can come to be. A lot of talking, a lot of discussion, and then the FASB says, here we go. So we take a moment to go into the different levels of authority in terms of what is GAAP. This is very important in terms of common law in the US. So for those that don't know, common law is the rule that if a judge anywhere in that jurisdiction makes a decision, then every decision afterwards has to be based off of that decision. So we're all under the same common law. How that applies to accounting is the fact that if somewhere, someone wrote any information on a procedure or a policy or a statement, technically that can be used as a basis for what would you consider a rule. And so we do provide this kind of hierarchy to determine which of those rules is more important than the other in the case that they conflict. The general is you start with GAAP, which is what's called the standards codification. Everything else after that is a recommendation, but has been superseded. A lot of history just to tell you, go read GAAP. Does that make sense? So again, we start with the standards, and then from there are other less formal guidelines that we are going to use. We won't necessarily learn about these guidelines because these become in this very specific example for this very specific industry, for this very specific transaction. Here's where we suggest that you do this or do that. FASB tends to be a little bit more high level, not to the point of being IFRS on the whole. It is still rules, but they tend to be more general in terms of when you're dealing with this industry, these are the types. So So the highest level is the standard, what we refer to as the codification. The codification is part of the emergence. So GAAP and IFRS are continuously meeting in order to come up with a semblance of an international standard. What that means is that they've gone through each of the topics and they continuously meet and say, okay, on revenue, my standard says this, your standard says this. How do we meet in the middle that's going to be best for everybody? Since that started, FASB has gone through their entire relation and they call it the codification. So there's one level of GAAP, and that is the authoritative. Everything else is non-authoritative. So the way that you'll see that is, so each topic has a hierarchy. In that each topic, you'll get an overview and then goes into specific details. I'm not going to go into this far details, but your group project, this is kind of the goal, is to find out what does the codification say that we should do for this specific transaction, compare that to what the IFRS is saying, and then come up with your recommendation. Okay, I love this quote. Okay. So the problem that the FASB has is that when we say we need to be decision useful for the end goal, there's a lot of different end goals out there. Okay, so from a business perspective, we want to be able to show what we need in order to make the right decisions as a business. Bankers, they're trying to figure out what do they need in order to determine if you're going to be solvent next period. As a preparer, I'm going to have certain ideas that I need to keep with government, the SEC, IRS. They're all going to want to see information. Everybody wants to see their specific in a different light. So FASB has to kind of weigh each of those and come up with a rule that suits everybody. And again, as we go through this class, we're going to go into more details on exactly what GAAP does. And so it'll show you how we make that determination. Certain rules are going to be more geared towards one of these versus the other because of the fact that we have to trade. Okay, so the expectation gap. So expectation gap is just is any variance between what you think is going to happen and what actually happens. If you've never had an accounting course and someone asks you what an accountant is, generally the thought is that accountants are there to make sure that the numbers are right. Being right is not necessarily something that we can do. We can get as close to it as possible. And you've seen where things get wrong when we talk about Enron and Arthur Andersen and a lot of those. So to kind of close that gap because of the different scandals, you'll hear Sarbanes-Oxley Act. This was, other than the SEC Act of 1933, this was the largest legislation in the US. It changed accounting overnight. The biggest component, the biggest reasoning for that is the Sarbanes-Oxley requires all companies now not only to sign off on the financial statements, but sign off that the controls and the process and the procedures that generated those financial statements at a level to prevent material misstatement. So again, not only are companies reporting on the numbers, but they're reporting on how did they get those numbers. And you can see the numbers is probably maybe 2% of the overall work. And now we have to figure out all of the processes and procedures. It also put into place the PCAOB. So we talked about AICPA deals with the CPAs, SEC kind of oversees, FASB deals with the actual GAAP. Now you have the PCAOB. They're there to be the watchdogs of the auditors. So the PCAOB's job is to audit the auditors. So again, if you have financial statements reported on the SEC, you have to have an auditor sign off on those. If you're an auditor, the PCAOB has to verify that you're doing what you're supposed to be doing in an audit. And that is a lot more detailed. So it creates peer review, it creates PCAOB reviews. My claim to fame was that I got to sit across the table from a PCAOB member my second year of audit. Not a fun experience. The PCAOB is a government entity, therefore it is highly politicized. But at the end of the day, it's there and we have to do it. Right. Any questions at this point up to GAP? I feel like we're going through it pretty fast, but I see a lot of nods, so continuing. All right, so all of that, you would think that it's easy. Everybody wants these numbers. They're numbers. How 9 is 9, 1 is 1, 1 plus 1 is still 3. What are you going to do? So here, what's the problem? Why can't we come up with some form of agreement here? So these are the 5 challenges. So the one is non-financial measurements. And what that means is that there's a lot of value, a lot of focus on things that we can't put into a number. So the biggest one there is the employee workforce. Without a doubt, that's been shown over COVID is companies that succeeded versus failed is going to be based off of whether or not your people were ready to deploy those methods, where the knowledge was there to work from home, the infrastructure, a lot of things just couldn't have happened without the people. But how do you put a number on people, right? How do you put a number on the value of these people versus those? And so because of that, there are things that we just can't get to that stage. And so we put as much disclosures and we put as much language in there, but it is a challenge. The second one is forward-looking information. Again, for you finance majors in here, you're not necessarily worried about what happened last week. You want to know what do you need to be worried about next week. But again, as an accountant on these financial reports, we can't tell you, it can't be accurate if you have something in the future. So we need to be looking, we need to have information there to be able to make that forecast. But at the same time, we can't put that in there. So everybody wants to know what your revenue next year is going to be, what your dividend next year is going to be. But without that information, we can't give it to you. So that's a challenge on, again, what the expectation is versus what we can physically deliver. Soft assets, that's you're talking about intangibles. So we talked about we talked about the employees. There's also trademarks, there's software, there's goodwill, all of these other things that, again, you can't put a hand on it. I can't tell you how much McDonald's brand loyalty is worth, but I can tell you there is value there. But without being able to touch it, without being able to see it, without being able to take the brand outside of the company and sell it to someone else, it's really hard to come up with a monetary value that places it in a financial statement. Okay. Timeliness. The issue with timeliness is the fact that we're supposed to issue these reports every year, but it takes time to close the books, to book the journal entries, to do the audit, to verify that our procedures are there, to go through the whole issue. So by the time we're actually issuing the information, it's already historic. Okay, so the investors want it more and more and more and more. And now with the day stocking and trading, every second delayed could be the difference of a few $1 million here or there. So the issue is, how do we get this information to you quicker and still be accurate? Okay. Understandability, again, as we go to a wider view of people and users and shareholders, the ability to use a single definition in a single language becomes a lot harder. So the question is, how do we make these financial statements understandable to a user that doesn't necessarily have the same background as we do, but yet where do we draw that line of useful time, forward looking? Does that make sense on what the challenges are and kind of, and again, as we go through each of the specific assets this semester, you'll see the trade-offs that we make, for one of these versus the other. I'm gonna pause for any questions. So I'm getting to running out of time. We're about halfway through the slide, so let's go ahead and jump out and then jump back in real quick, so that way we don't stop in the middle of something.